Hello and welcome to the Bloomberg Davos debate. I'm Francine Lacqua. Well, for the next hour, we will be discussing some of the major economic issues facing the world with our illustrious panel. But we start with the fast and loose money that is sloshing around the world and the tensions that it's creating, a phenomenon some are calling currency wars.
Remains undervalued.
The yen is misaligned.
Many do consider their currency as a weapon.
These policies have the effect of keeping the Chinese currency substantially undervalued.
What we want is that the US value their currency and not devalue their currency.
Is there a war between the dollar and the yuan? Is there going to be a breakthrough? It's not what I'm most focused on.
This exchange rate flexibility, in our view, is very, very much in the interest of China.
The days of Chinese low-value added exports are over.
Well, now let's get straight to our panel. An impressive lineup from the financial world. The CEO and President, Bank of America Merrill Lynch, Mr. Brian Moynihan. We have two central bankers, Stanley Fischer from the Bank of Israel and Mark Carney from the Bank of Canada. Two ministers of finance, Poland's Jacek Rostowski and Turkey's Mehmet Şimşek, as well as noted economic historian Niall Ferguson, who teaches at both Harvard University and Harvard Business School. Thank you so much for joining us. Neil, I actually wanted to kick off with you. We're hearing, of course, about currency wars. Some are refusing the term altogether. But is it actually a reality that until we get very good growth, there will be protectionism and certain countries will want to manipulate the markets?
Well, I think the phrase currency war is warranted. After all, it's the title of a best-selling book in China right now. So it's certainly a reality in what is now the world's second largest economy. The nature of the war, though, I think is widely misunderstood because it's often represented, and it was in one of your video clips there, as a war between the US and China. I think that's not the case. I think, if anything, if there is a currency war, it's between what I call Chimerica, China and the United States, and everybody else, particularly some of the other emerging markets, which are finding that their currencies are strengthening while the China, pegged more or less to the dollar, isn't in the same way as it clearly should be. I mean, if market forces were given a free rein, there's no question, and I don't think anybody here would deny it, that the RMB, the Chinese yuan, would be a stronger currency.
Minister Şimşek, your country, of course, relies a lot on exports. Do you feel that there's too much intervention on the markets in general?
Well, certainly there is. I mean, I think on one hand you have got China attempting or trying to keep currency competitively undervalued. And on the other hand, you have obviously Fed flooding the world with dollars. So countries like Turkey are suffering simply because we have to deal with excess liquidity, and it complicates monetary policy, and certainly it does create difficulties. We are now implementing an unconventional, let's say, monetary policy. We're lowering rates aggressively, but at the same time, to prevent loan growth getting out of control and overheating, we're actually raising reserve requirements also very aggressively. Plus, we are introducing some form of uncertainty to the exchange rate market. So the difficulties are there. I mean, we are competing with China on many of products to European market. So competitive undervaluation is certainly a big problem for us. And U.S. and other, easy money policy elsewhere is creating also difficulties.
Stanley Fischer, a lot of economists blame both the U.S. and China for these global imbalances. And certainly when it comes to the U.S., some say, well, when you put so much cash out there on the markets, QE2, you have to think of the consequences for everyone around the world. Does the U.S. need to be more careful?
I think the prime responsibility of the U.S. is to get its economy back to growth at a reasonable rate. And its fiscal policy is extremely expansionary, and its monetary policy needs to be as expansionary as possible. Any time a country reduces its interest rate, more capital tends to flow into other countries. That's part of the adjustment mechanism. I don't think this QE2 was an attempt to weaken the dollar as much as an attempt to get domestic growth started. And I've said that faced with a choice as a central banker between a situation in which it's comfortable for us and the U.S. is growing slowly, and B, a situation in which the U.S. is growing rapidly and we have some problems dealing with our exchange rate, I take situation B any time, because the U.S. economy is coming back to growth as the essential change we need in the global economy.
Mark Carney, you second that?
If I'm given a binary option, absolutely second it. And let me put this in some context. I mean, bar China, we are the largest trading partner of the United States. We're the most integrated financial system with the U.S. And we entirely understand why the Fed has pursued the monetary policy that they have. They needed looser monetary policy. They took those steps. And let's just also put this money, quote, sloshing around into some context. Capital flows to emerging markets are still 2 percentage points of GDP lower today than they were in 2007, pre-crisis.
And yet we talk about asset bubbles. Brian Moynihan, how does that impact the way that you do business? We talk about these global imbalances. We've been talking about them, frankly, for the last decade. But now it seems that they're getting worse because of the crisis.
Well, I think two things. One is I think the economies of the world and the U.S. role in that as a major economy, and particularly the role of the U.S. consumer, the affluent consumer, and the purchase power and the consumption power, is something that I agree from a central banker standpoint, you need to get that rolling at a modest, a reasonable growth rate. And I think most of the decisions made in the U.S. are to make sure that there's no air to the downside and keep the upside inflated. As we look around and hear our clients talk about doing the business around the world, there's been a fundamental change over many years now that is really coming to bear, which is, multinational companies can do business anywhere. And the U.S. is in a position where they're competing for labor, and getting their labor back to work against economies all over the country and consumption all over the world. And so it's a more difficult thing to solve to get the unemployment down and other things in the U.S. So I think the Fed and the Federal Reserve and the policymakers have been doing their best to make sure this economy stays gliding along, and we're seeing grow and we're seeing consumption come up. And I think that's critical because that will help straighten out the imbalances just with that. And then our companies, because they can be so fluid in the global economies, have more choices. And I think long-term the U.S. has to have a good fiscal policy, good tax policy, and those companies then will locate their people all over, including the U.S. But right now, some of the advantages are to go other places.
Jacek, Rostowski, how worried are you about the global economy in general and the fact that we actually can't really deal with these global imbalances?
Well, I think the global imbalances were a very major cause of the problems that brought us to the crisis. But I agree with Stan Fischer that what people call currency wars today, people call competitive devaluation today, in the way in which the Federal Reserve is conducting its policy, is actually not the problem, it's the solution. And if we go back to Ben Bernanke's famous book on the Great Depression, that's when he pointed out that Keynes had actually got it completely wrong. That what the 1930s exactly needed was a lot of devaluation down of gold. Well, we're not on a gold standard, we've got a completely different system, but the equivalent of that today is the kind of quantitative easing that we're seeing from the Fed. But, and this is my only quibble, if the United States has got a problem, it's a medium to long-term problem, on the fiscal side, and it may need a slightly tighter fiscal policy, but I don't think it needs a tighter monetary policy.
If I could, may I just come in on that, because I entirely agree. And what we see now is the reverse of what happened in the 1930s. I say this with hesitation with Niall here, but instead of having that series of devaluations for the countries most affected, because of the interventions, there's this sort of death grip on the U.S. dollar, which is preventing the adjustment of currencies. And part and parcel of that is the monetary policy of the U.S. is being applied in countries where it's totally inappropriate.
But this is above all China, and it's a question of the kind of currency regime that they have, which, well, that's their currency regime. Maybe we can move on to that later.
Yeah.
Well, if you look at the 1930s, it's clear that we learned from history in two pretty big ways, and that's why we're not in a Great Depression now. In fact, we're in a mood of near euphoria here at Davos, I think rather overdone euphoria in some cases. We threw massive fiscal stimulus at the problem instead of trying to balance budgets. And there has been enormous monetary stimulus from most of the major central banks. And QE2, quantitative easing 2, is just a fancy name for more monetary stimulus. The problem is that not everybody can have a weak currency simultaneously. And in this game of competitive devaluation, it's very clear that the Chinese are winning and have been winning for some time, with estimates of the undervaluation of the order of 30, 40, even 50%. I think that's the problem for the emerging markets that are seeing large appreciations in real terms of their currencies. And it's been a problem for Brazil, it's been a problem for Indonesia, and so on. For them, the adjustment is essentially being passed from China and America to their economies. And that is a very dangerous thing. The other problem, which again differentiates us from the Great Depression, is that we are letting the inflationary genie out of the bottle. Now, there is a view, which is still very prevalent in the United States, that there's no inflation risk because of all the slack in the economy. I think this is misplaced because much of this slack in the labour and capital market is actually dead wood, and it won't come back on stream as the economy recovers. Looking at commodity prices, the big scare from the point of view of emerging markets is double-digit inflation in food prices. And we know that that's not just economically disruptive, it can be politically and socially disruptive too. My worry is that Fed policy is now the monetary policy of the whole world. And what is sold to American voters and indeed to the wider public as a solution to the problem of unemployment in Michigan ends up being a cause of major problems in commodity markets around the world.
Brian, is there a concern actually that the world is now addicted to this cheap money, whether it be through fiscal policy or monetary policy or QE2?
Well, I mean, Neil just talked about that. There's a worry always that you get used to this interest rate environment and you get used to it and cheap money and et cetera. But I think the real question is America has a near-term and long-term problem. The near-term problem is how do we stabilize the economy and what's gone on in the last couple of years. The long-term problem is we've had a fundamental move of manufacturing jobs out of our country for many decades, and we've got to create the new jobs of the future, and that's a longer transition. And we got to get our fiscal house in order. And so that, I think, there's no question our currency long-term will reflect the strength of our country. And until we get our debt and everything in shape, the issue is we can't do that now and actually do what we need to do. Some of the other colleagues have talked about here to keep the economy going and keep the world going. So this is a short-term, long-term question. And I think you can overread where we are today because we couldn't err to the downside. But I think there's an absolute recognition long-term that we've got to get the fiscal house in order, which will then take care of a lot of the issues we're talking about.
Stanley Fischer, are you concerned that actually China, on the other hand, is overheating and that there's too many steps being taken to cool down the economy?
Well, there are lots of reasons, particularly in the housing market, to think that China is overheating. But every year that you come to Davos, there's some problem in China which is about to cause it to blow up, and somehow the next year you come, there's another problem that's about to cause it to blow up. You have a group of very smart policymakers there who've done very well in dealing with a variety of problems, including the potential collapse, which we were worried about 2 years ago. So I suspect they'll take measures to cool down the economy, and perhaps they'll only grow at 9% this year instead of 10%.
Mark Carney, how difficult is it to be a central banker today?
It's a lot easier than it was 2 years ago. No, I mean, these are serious issues, and I would pick up on the commodity point that Neil made. Take it from an advanced economy perspective, we have to hold our nerve through what are potentially one-off shocks for commodity prices, and look through that and manage inflation, monetary policy appropriately. The dysfunctional nature of the international monetary system is complicating our job without question, but we can still achieve our targets, and we are doing so.
We had George.
Just to come back to the point that Neil made about non-Chinese emerging markets having a problem with price inflation and food inflation in particular. If that's the case, then currency wars are the solution again. They can let their currencies appreciate and they'll have less of an inflationary problem. I mean, it really isn't news to anyone that every country has a short-term trade-off between inflation and economic activity. I think one of the, I think we all know that, and there is possibly an additional longer-term problem for the West versus the rest, in that with industrial activity and economic power shifting particularly to Asia, it may be the case that the West will have to get accustomed to paying more for various commodities. But on the other hand, the supply elasticity of many commodities will probably in the medium term be a lot higher than we imagine in the short term.
Mr. Szymczak, we had George Soros actually saying that the commodities will continue rising, but it's just a bubble for the next 2 years.
Well, it's probably less of a bubble. It's probably to do with how China goes from here. I mean, if Chinese growth remains as strong as it has been, along with India and other big emerging markets, there is underlying demand. There may be some, issues to do with trading of some of these commodities in certain exchanges, but ultimately you need to have underlying demand. I kind of disagree with some of the stuff that is said here, because China has accumulated, is now heading towards $3 trillion of reserves. Clearly, there is manipulation. Regardless of the U.S. intentions, the implications for many emerging markets and other countries have been very significant of what Fed has done or what other countries are doing. So there is certainly a problem. We did not import U.S. houses, but U.S. housing market problems turn out to become a major global issue for everyone. So I think if they could come up with a credible fiscal policy, I'm not talking about tightening today, but at least a credible medium-term fiscal framework, that might help. I think that applies to many other countries. So certainly it's very difficult to, at the early stages of the global crisis, during the at G20 level, there was a lot of talk of coordination. Now that a global sort of, let's say, recession, a problem that was contained rather than leading to a global depression, I think now everybody is going their own way. I think that's an issue, that's a problem. Global imbalances are there and probably going to grow, and I think if everybody pursue the type of policy they are doing, we will have to take measures. And many countries are doing. Brazil is taking measures, Israel is taking measures, Turkey is taking measures. So whatever you call these, whatever you name it, is in one format or another, there is something going on.
Brian, does this actually change the way that again, you talk to your clients for the foreseeable future?
Well, I think we reflect more on what our clients think and talk about and do, and they seek opportunity around the world, and then we build our business model to serve them. So, I think that the reality is the demand that's building up in Asia and stuff leads a lot of our multinational clients to have 70% of their revenues outside the United States, and 30 or 40% of them, they're following the demand curve for infrastructure and computers and software services and all that stuff, and that's where the demand is, and that's where the people are going. Much like over the course of a year in demand for our investment banking services, we're flat headcount. We have 1,000 more people in Asia than we at the start of the year, so we're driving that. So I think it causes you to think about where you put people and resources, and human beings are our resources, where you put capital, where you participate in the markets, and then where you help create capital markets so that the funding can go on. And then from the client side, it really is down to, a lot of people think housing was a problem in the United States. There was actually a much longer term problem. Housing actually covered it up for a while because it created an activity. That's now gone. And what you're seeing is the soft underbelly of years of decline of manufacturing jobs that we're going to have to figure out if we can stop or not. And our economy is dealing with that. And so our high unemployment rate and stuff is not because of housing at this point, because consumption is back to where it was in 2007. It's because underlying that we don't have the manufacturing base, and we have to figure that out as a country. That will be on American companies' minds as we move forward, now that we're through the worst of it.
Let me make a basic point, and it goes to the Minister's point on adjustment. There will be adjustment. Given the scale of the economic miracle in emerging markets, and it's very welcome, there is going to be real appreciation of these currencies. If you look back since 2000, the BRIC country currencies versus the G7, they've appreciated 5% in real effective terms, minor, even with recent movements. China, back since 1990, versus the U.S., it has not appreciated in real effective terms. So there is going to be this adjustment. It's going to move, and it can move on the nominal exchange rate, or it can move through inflation differentials. And just to bring it back to what Brian was talking about, from a client perspective, from a business perspective, it's much more attractive if it happens in an orderly fashion, if it happens in an element of price stability, both in emerging markets and in the developed economy.
And I think going back to how hard your job is, Mark, that's the judgment. Is how do you keep it, and from a business perspective, that's what we all watch, is can they keep it rational in the movements, not touch the third rail, keep it going. And that's the difficulty, and that's what makes your job difficult, is to manage that going down the tracks without touching either side of it.
Just to come, I'm sorry, Stan, go ahead.
When Minister Simcek talked about coordination, in the fall of 2008, it was very easy to coordinate policy because every country agreed to expand fiscal policy. Well, when all you have to do is spend more money and everybody else agrees that's a good thing to do, you can coordinate. Now we're at a stage where some people have, in essence, to forego some growth in order that others may grow a bit faster. Getting coordination on that is a totally different sort of problem and much harder to solve, and that includes the problem of global imbalances. Second point on whether we have a bubble in commodity prices or not. You can always have a bubble. We certainly had one just before the Lehman case with the price of oil and so forth. But given what the increases in demand for commodities from Asia, particularly from China and India, it is very likely that the relative prices of commodities will rise for quite some time. That will not be a bubble. And we're going to have to find ways of deciding how to accommodate that, whether to let it go through into inflation or whether to try and push down inflation nonetheless.
Yes, I am entirely. That was the point I was trying to make about the shift of power towards the West, and I agree with you entirely on that, Stan. Coming back to the point that Minister Simcek made about currency manipulation, it's like the old joke about if you owe the bank $1 million, you've got a problem. If you owe them $1 billion, they've got a problem. Well, in a similar way, if a country has $3 trillion of reserves, that's not currency manipulation, that's an exchange rate regime. And the question is whether that exchange rate regime is sustainable. And if it isn't, then we're going to have a very major problem somewhere down the line. I have no reason to suppose it's not sustainable, but that's really the $3 trillion question.
Is it sustainable?
Well, I think there are two questions that we need to address as well before we get to that one. One is whether the dollar is going to continue to be the international reserve currency if policy continues to be so domestically focused and little regard is paid to the external effects of QE2. The other big question, which hasn't been mentioned at all, is the future of the euro, which for many people seemed to be a rival to the dollar and which has been plunged into a profound crisis in the wake of the financial upheaval. And on these two issues, I think it's far from clear. My own instinct is that the dollar's future, its days as a reserve currency or as the sole reserve currency are numbered, and that if we look ahead 10, 20 years, it will simply be a less important part of central bank reserves. As for the euro, I think it's far from clear that it is out of trouble. And indeed, it becomes easier and easier with every passing week to imagine a fundamental breakdown of the system because of structural problems that can't be overcome inside a single currency regime.
Now, let's talk about the euro, actually, because it was one of the big talking points here in Switzerland. Will at least one nation leave the euro area? Well, we had a poll earlier in the week, and a recent Bloomberg poll of global investors said that 59% of respondents see that happening by 2016. Around 10% think that the exit will come even sooner, within the next 12 months, and less than a quarter are confident that the Eurozone will remain intact. Well, global investors also see sovereign defaults on the horizon. 3/4 say that Greece won't be able to repay bondholders in full, and about half think that Portugal and Ireland will also follow suit. Grim readings. Do you agree, or is it just investors being scared? Stanley?
I don't think that's the right question. I'm glad you asked it. But the question is, will the euro as the currency of most of Europe survive? And whether one or two peripheral countries leave is very interesting and will provide a good precedent for the future, instructing countries as to how to behave well. I very much doubt that the euro will not be a major currency 10 years from now or 20 years from now. I think the bloc has passed the point of maximum tension and is probably heading, I wouldn't say to a safe harbor, but to less stormy seas.
Minister Rostowski, you're watching this, of course, very closely because you're probably the closest amongst the panel that is, in the Eurozone. Are you concerned about the fact that we haven't really been able to have the silver bullet kind of package to stop all the speculation?
Well, it's interesting that I'm sitting next to the governor of the Canadian Central Bank, because when I think about the euro, I often feel like Canadians often say about the United States, it's like being in bed with a whale. And we're obviously outside the euro, but what the euro does or what happens to the euro has that kind of impact on us that what happens in the United States has on Canada. I think a good way to think about this is to say to ourselves, how would 2008 and 2009 have looked had we not had the euro and had we had an EMS instead? And if we think about that, we realize what unbelievable tensions there would have been within Europe. The massive realignments of currencies, between the major countries, that very probably would have happened. The huge capital flows, the very, very powerful disruption that could have translated into massive financial sector costs. And if you realize how much Europe, even those countries which are outside the Eurozone like Poland, have gained from there being a euro, you will understand how much the European countries, particularly those inside the euro but not only, are willing to do to maintain the euro. And, we came through 2009, 2010 thanks to the euro. We've now got the hangover from a successful navigation through that crisis. And it's really a matter of, it's a bit of a tussle over how the costs of that successful passage are going to be distributed. And in the end, we'll find a way of distributing.
With all due respect, Minister, you seem to be contradicting yourself, because earlier in this debate you were a great proponent of exchange rate flexibility as the solution to the problem of global imbalances. Well, those countries that lost exchange rate flexibility by joining the euro have paid the heaviest price of any countries practically in the world economy. Take a trip to Ireland, where people in jobs like mine have just had a 30% pay cut inflicted on them as part of the austerity package imposed by the Irish government in the wake of this crisis. I think from the Irish point of view, from the Portuguese point of view, from the Greek point of view, being outside the euro in a flexible exchange rate mechanism would have been far preferable. They could simply have devalued in the way that you earlier advocated and avoided these appalling, crunching austerity budgets.
But the issue is not, and I think I'm going back to what Stan said, whether it would have been better for one or two peripheral countries. And I think Greece is a case apart, because Greece has obviously had much bigger fiscal problems than the others. But the issue is not whether a particular country would have been better off having been outside the euro. The question is, are you better off leaving the euro now? Let's assume that Ireland made a mistake joining the euro. Is it better off leaving the euro now, given the kind of public sector debt it has, the kind of private sector bank debt it has? And that's one issue. And the other issue is, will the euro itself in any significant way and in its core break up? And that, I think, there is absolutely no possibility, because of the huge benefits that we've had over 2009, 2010 from having the euro. And those are benefits for peripherals. I mean, you might say, well, a country like Ireland, given the existence of the euro, might have been better off outside it. But compare that to the situation where there was no euro at all, Ireland probably would have been even worse off.
Well, I think that's high.
And I think that's actually very likely. And I think we disagree fundamentally.
Yes, I think we do.
But nevertheless, Ireland is in the euro now. Would it make sense for them to leave under present circumstances? I can't imagine it.
Well, that's a different question,
it's a passionate debate amongst you two, but I want to ask actually, how do you feel, Brian Moynihan? It's, on the other side of the Atlantic. Are you as passionate and get as riled up as these two gentlemen?
I think I share the view of the finance minister that we see the euro holding together. We see that it's a committed to structure. We see that the power of it actually is what happened. I mean, the power. And as I look at the United States, California is, I don't know, the sixth largest economy. But when we went to fix liquidity and fix it, one authority could talk and fix it. And that's a little bit what people long for, is to how to have the shock and awe, or whatever you call it, to put it behind you. I think the euro provides at least a vehicle of which they could go to work. And so we see it, we see it going forward, and we see that it's been through its troubles. And so that's the view of our experts that study it and think about it and how we position a company. But it's going to have its pluses and minuses on a given day, as the two colleagues were arguing about. But we think it's fundamentally there. It's survived a major test, obviously.
Well, I was trying to think while we were talking about Ireland and how you do counterfactuals. And the case of Iceland came to mind. There's a country which had a very similar problem, namely a banking sector which got much too big. I would guess if we didn't have the Iceland example, we'd say that the Irish banking system could grow only because it was in the Eurozone. It wasn't true. It happened to other countries, and that was at the core of the Irish problem. And I don't think, Neil, that there are easy devaluations in these circumstances. When you said, they could just devalue, I think when you have a big banking sector problem, just devaluing is also a big mess.
I think one of the things that you bring up is the banking sector size relative to the economy. It makes the problem we all faced very different by country. In the U.S., 60% of the financial assets are not in the banking system. And in the U.S. banking system, the size of the economy is, 30% or something like that. And so it's a much different struggle than Iceland or Ireland, when you have your banks have gone out in the world and accumulated a bunch of activities, and you're dealing with them. So I think that is a different issue, but it's an issue which is in the background of how you're going to handle your fiscal policy and stuff. And will countries in the future, having learned what they learned, allow their banking systems to reflect the world or their own citizenry in size and scale and scope? That's not the subject of debate in currency wars. That's called capital wars. But
I think we agree that the euro will survive, and I don't want to give the impression that I think it won't. I think it will survive because I think particularly Germany, the core country, has too much to lose from its breaking up. But the key question is whether it survives with a low-growth economy or a high-growth economy. And my fear is that the way things are presently set up, with constant divergence in unit labour costs, it will survive, but in a low-growth Europe, in which the periphery will fare especially badly in an almost permanent deflationary situation.
Minister Jacek, and then we'll come to you.
I think, yes, euro will survive, but Germans will have to pay for it. There's a big cost associated with that, assuming that one or two of those countries fail and ultimately end up restructuring. German and French banks will pay for it. So there is a cost associated with that. Secondly, I think what we have noticed is that prior to the crisis, some of these countries were not penalized by the markets for irresponsible fiscal policies. So the risk premia, let's say, that was incorporated in some of these countries' spreads or yields certainly were substantially lower because of euro. So these countries have benefited tremendously from being in Eurozone. Nobody would probably want to walk out of it. And euro, yes, I agree. There is a political commitment, and it will survive. But I think ultimately a few years down the road, a couple of years down the road, when it becomes clear that the fiscal adjustment is too big for some of these countries to deliver, ultimately some countries will have to pay for it.
Mark Carney?
Just very quickly, I'll pick up on both those points. I agree with Neil. This is a question of unit labor costs and competitiveness. Ultimately, it's a question of growth. The question of fiscal sustainability in the peripheral economies is a question of growth. And the scale of the adjustment that's going to be necessary to reestablish that internal competitiveness is considerable. It is considerable. So on top of that, you have banking sector issues and a fiscal overhang, but the underlying competitiveness of these economies within Europe is very challenging. So there needs to be big gains. There needs to be effective deflation in unit labor costs. You can drive it through productivity, or you can drive it on the price level. And just to bring it back to where we started, this is what we have to avoid on a global scale, which we lock ourselves into one system. So that's the only adjustment where you have to have effectively deflation in certain economies in order to re-equilibrate.
We're going to take a comment from Mr. Rostowski, and then I'm going to throw questions to the floor. So,
just on that, I think what we've had for the first time now, but after all, the Eurozone crisis has only lasted a year. Let's not overstate it. But at the last ECOFIN, Olli Rehn presented the first growth report that the European Commission has presented. And we're now going to start looking, and I can say this as the presidency of the European Union in the next half of this, the second half of this year, we are going to have to start looking at European legislation in a completely different way from the way we have. We've tended to look, in particular councils, the Labour Council, the Environment Council, and simply say, is this a good thing? And we've never looked at costs. And we're going to have to change that. Countries are going to have to make themselves more competitive through structural reform. It's the first time that we hear the word structural reform in EU documents stated seriously. And I think that's a breakthrough. But we're also going to have to do it at European Union level. Completely different approach to laws that increase costs for the public sector and increase costs for the private sector. And certainly the Polish presidency is intent and determined to take a lead on changing that attitude.
Do we have a question from the floor? It'd be great to hear from someone about, for example, whether Germany is prepared and for how long to pay it. Gentlemen.
My name is Mickey Pant. I work for Young Brands. Question for Mr. Moynihan, which is, how do you evaluate the prospects of the U.S. housing market for 2011, and how do you evaluate the risk of your portfolio?
The second part I didn't hear.
How do you evaluate the risk of your current portfolio with the large mortgages that you hold?
I didn't know this was an earnings call. If you see what's going on in the U.S. is our company would reflect the broad economy because of the size and scale and what we do, is that you've seen charge-offs come down for 7 quarters in a row, delinquencies come down, yet we still have serious unemployment. And people could say, how could that be true? And the reason why is we have sustained unemployment. So a person became unemployed a year ago, is still on benefits, and we have to sustain those benefits from a human safety net standpoint. Doesn't not pay us twice. They quit paying us 12 months ago. And so as this has gone on, you're seeing a delinkage from unemployment levels and credit quality for consumers in the United States, which is confusing to people because it used to always be a correlation. So that the portfolios are healing across the industry. Housing is a long tail process just because the process of moving housing, which is a human element of huge dislocation in the United States, we've never gone through it. Housing's always gone up, it's gone down for a year or two and then come back. And so we're dealing with this dislocation for several million homeowners across the country that we're going to have to move from homeownership to a different style of housing. And the issue that we have to focus on is good housing for the people as opposed to a house that doesn't have the equity in it today. And so we're working that process. It's been, process-wise, it's been messed up. It'll take a 12, 18, 24 months to move through that process. Meanwhile, there's this big belief in the overhang of the housing market. There's no one that does not know that that is out there. And houses sell. As soon as we actually take possession of a house, it sells within 60 days. So the housing market is getting there, but it's going to bump along the bottom, and it's not going to drive the U.S. economy at all. And it's been a fundamental driver since the Second World War forward to the U.S. economy. And that reality really goes back to here to talk about the questions about how you compete in the worldwide stage at the Euro level. You just take out Europe, put in the United States, it's the same questions. And I think that's the long-term reality we face is housing can't be as big a part of the economy, but it's healed, it's getting better, it's bumping along the bottom, but it's going to take 12, 18, 24 months to work through the foreclosure issues and get through them. We've all restarted, but it's a much slower process now.
Stanley Fischer, I actually wanted to ask you something about the reserve currency. If we are going to move away from the dollar, what can replace it?
Well, I'm more optimistic about the euro gaining strength as a potential reserve currency. Still think the dollar will be the dominant reserve currency for a long time. Euro will catch up, and we ourselves are diversifying to currencies which we never would have put in the reserves before, including an Australian banker sitting in front, Australian dollar and so forth. And I think people will diversify their reserves, and then a long way down the road as China's capital markets improve, and possibly as India's economy catches up with China's, we'll see major Asian currencies becoming reserve currencies as well. I think we will not have a more or less single. We never had a single reserve currency, and we'll probably have more than we've had in the past.
Minister Jacek, and then I'll take a question if someone wants it on the floor. Do you think that we need to find another reserve currency?
Well, I mean, I think if U.S. continues the way it is in the current environment, certainly countries will look for alternatives, because you can't print so much money and expect no consequences. So that's clearly the case. I agree with Governor Fischer that ultimately the center of gravity is shifting towards East, China, India. Right now, obviously, they're not visible at all in terms of reserve currency, but certainly 10 years from now, it could be a very different landscape. And I do agree that ultimately, euro is going to probably remain an important reserve currency. But I think many countries are now looking, to see what sort of fallout will be in terms of their reserves. Obviously, China will probably suffer the most, considering, even though they don't disclose how much of their, FX reserves are in U.S. dollar terms, but most people tend to think that the majority is in dollar terms.
Let me say two things here. I broadly agree with Stan, as always, that over time there will be more of a multipolar system. Other currencies will play a central role in reserves. But my basic point is, the fundamental question isn't about the reserve currency. It's not what is the reserve currency. It's the adjustment mechanism of the system. And if countries persistently intervene against whatever the reserve currency is, frustrate adjustment of surplus countries running current account surpluses, persistently intervene, the system doesn't work well. And ultimately you end up getting the same adjustment in real exchange rates through generalized wages and prices in all the other economies. And that's a bad way to do it. And so while the reserve currency will solve itself, countries will earn their way in or fail their way out of being reserve currencies. Ultimately, it's about a shared commitment to a system.
Reserve currencies have a way of dying slowly, and that's the lesson of the British experience. Remember, sterling was the dominant currency in the world until the Great Depression, and its death began in 31 and wasn't really consummated until 76, which is really quite a long time. And there's a reason for that. It's quite hard for these things to change overnight. But what were the reasons for Britain's decline as a reserve currency nation? One, slow growth after the war. Two, excessive debt. And in particular, three, excessive external debt. Now, these three things we see, potentially at least in the United States. Unless the United States, this goes back to the beginning of our conversation, really sees a pickup in growth, it starts to look an awful lot like post-war Britain, saddled with a very large debt, with an underperforming economy and a lot of external debt. And that's why over the long run, I think the dollar is likely to slide and lose its preeminent position that it currently enjoys today. The other really interesting point, which hasn't come up, is the importance of commodities. We're not going to go back to the gold standard anytime soon, but the currencies that look strong to international investors, often the currencies which have some serious hard commodities behind them. Hence the appeal of Australia, and it must be said also the Canadian currency, once thought of as weak and now one of the strong men of the international currency scene. Mark.
Thanks, Neil. Let's move right along.
No reaction?
I'll just let it slide. Yeah.
I hope you won't let it slide.
One of the criticisms, actually, that we've heard over the last couple of weeks and also here in Davos is that we don't really have the proper forum to talk about currencies. Some say the G20 is just too many countries, the G7 is too little countries. Do we need to find something in the middle?
I think the notion that it's a forum is remote from what the real problem is. Problem is differences of interests and the fact that people don't want to enter the agreement, which is obvious, which is some Chinese appreciation against the dollar and other currencies going with it. This has been discussed in the IMF, it's been discussed in the G20, it's been discussed everywhere. The underlying problem is an underlying conflict of interests and not a lack of a place to do it.
It's always been the case.
And Mr. Schwab would have volunteered gladly if all what was needed was a forum.
President Sarkozy, though, under the G20 presidency, seems to want to push the currency debate much more along than other previous presidencies.
We welcome President Sarkozy's initiative. The system is not functioning well. That's clear. It's clear by this program. It's clear by the comments made. And it's important that we have a shared understanding of how the system should work. I don't know that we necessarily need a special forum. I don't know that we have to go behind closed doors and work that out. It needs to actually be... we have a shared understanding under the Articles of Agreement of the IMF. they're not being honored. They're honored only in the breach. And I think it probably does need to be refounded, and we'd like to use the G20 to do that, if possible.
All right, we have a question on the front row there.
Hi, it's Yu Qing from China Business News. Panel talk about the reserve currency. I'm just wondering what's renminbi's future in this regard? Thank you.
Is it a question for anyone specific, or should I pick?
You pick.
You pick.
Okay, great. Minister Rostowski.
I think I'm the least well placed to answer that question. I've got quite enough on my plate worrying about the euro.
So is this an uncomfortable?
No, I'll take a first stab at it, and Stan will clean up. The renminbi over time should have a role as a reserve currency, but what's required for that to happen will solve most of the issues that we're talking about today, which is increased capital account flexibility, convertibility, flexibility of the currency. As it's currently constituted, as the current exchange rate regime, it has no role to play as a reserve currency. So it's part of the reform of the system, which could actually help adjustment to imbalances. So it's important, but it's very medium term.
Well, I think its future is very much as Marx suggests. And once again, the time frame is in decades rather than years. I'm sorry there isn't a Chinese representative actually on this panel, because it is so much the core of the debate that we're having. And I heard a very eloquent defense this morning at Davos by David Lee, the Chinese economist, of China's position. We must remember that not everybody takes the view that China has to appreciate its currency immediately. From a Chinese vantage point, that's an extremely high-risk strategy. So thinking in decades, as the Chinese tend to do, I think you can anticipate a time when the RMB is possibly even an equal of the dollar in the international monetary system. But I think we're talking 10, 20, more like 40 years down the line rather than 4 years.
Stanley Fischer, both the Europeans but also the US have tried to put a little bit of pressure on the Chinese. Is this counterproductive?
Well, it's very hard to tell. The theory of don't push us, then we'll do it on our own and stop bothering us is a nice argument to make. Whether it actually would result in anything is very doubtful to my view.
I mean, I think China is going to be forced by economic pressures of its own making to change, because, as we've been saying, if it doesn't adjust the nominal rate, then the real rate adjusts through inflation. And that is happening now. And I think the Chinese are very well aware of the risks that they're running, because you can't sterilize interventions on this scale indefinitely. So I think we're going to see a shift. And my suspicion is it won't be this year. I think it will come after the change of leadership next year. And it may well be that we'll be talking about a new Chinese currency regime 12 months from now.
Thank you very much.
Go ahead.
I mean, it's not going to become a flexible currency immediately. I think there'll be, as there has been in the past, periods of allowing a gradual appreciation of the renminbi, some percent a year, 6, 7 maybe, percent a year for quite some time until the imbalances readjust. Everybody's saying this can't go on forever. It's gone on for a very long time, and the testimony to that is it's gone on for nearly $3 trillion worth, which is way larger than anybody would ever have said you could expect to be accumulated in this program. It's gone far further than any of us would have said 10 years ago.
And it's historically unprecedented, because under the Bretton Woods system, neither West Germany nor Japan engaged in this kind of systematic reserve accumulation. Their currencies were periodically revalued, and that's one reason we look back quite nostalgically on Bretton Woods. I must say, listening to this conversation, I've become more and more convinced that something more needs to be done to move in the direction of a consensual realignment of currencies than just another G20 meeting, which I doubt very much is the right forum to produce that outcome. Bretton Woods might well be something we need to look back at. Sometimes people mistakenly said that they'd reinvented Bretton Woods in the last decade, but I think that turns out to have been a false analogy. What we may well need soon, if it doesn't come spontaneously from Beijing, is the kind of thing that happened after World War II and then happened periodically in the 70s and 80s, realignments of currencies on the basis of negotiation rather than of market forces, which often overshoot and undershoot, as we all know.
Brian, do you want to...
I think that there was a hegemon after World War II and in the 1970s, and this is an issue about whether there are two hegemons now. and it's much more difficult to redesign a system in that case.
Mr. Jacek?
Well, I mean, I think ultimately, if China is going to sustain this regime, I don't know how they will be able to do that, considering the imbalances that is causing it. So some sort of adjustment is probably, I agree, is inevitable, but the pace of it really is what we're discussing here. There has been some adjustment in the Chinese trade balance. Trade surplus has come down as a percent of GDP. Current account surplus has come down compared to pre-crisis level or compared to a few years ago. But I think the pace of it is very slow. And so that's really the question that we have right now, because many emerging markets in that region are competing for the same markets on similar products. And I think the Chinese policy is certainly not helping in terms of distorting. It is a competitive undervaluation rather than devaluation here we're talking about.
Mark Carney, you had something to say.
I always have something to say, but no, I think it's interesting, Niall's point, in that we have a hybrid system. We have both a fixed and floating system, floating between the advanced economy currencies and quasi-fixed for a broad range of emerging market currencies because of largely the China dynamic. And so the question becomes, how is that adjustment, that real adjustment, going to come? Could you see, as a transition, the type of scenario that Niall just painted for the quasi-fixed? It's possible. I think that's part of the discussion that needs to be had in terms of, as China becomes economic hegemon, a joint economic hegemon with the United States, what is its role and how is it transitioning in its role, and what are its responsibilities as well as its receipts?
Thank you so much. We're actually out of time at the moment, so I want to thank all of our panelists for taking part in this discussion, also the floor. And, well, if you want to see this debate again, Bloomberg will be airing it throughout the weekend, so check your local listings for that. And certainly what this debate has taught us is that we're nowhere really near a consensus on where currencies should go and revaluation and whether we need some kind of reserve currency to replace the dollar. Thank you so much, and have a great forum, everyone.